All right, so thank you everybody for being here for our third quarterly meeting of the year. Happy August, as I said earlier. Before we get started, we have a couple of messages. One of those messages, and sorry for making you put your camera back on, Susan, but you're going to be message number one. Uh, but a message about our upcoming Data Users Conference that's in November. I know it's a little bit far out, but Susan is already getting that going. So if you wanted to say something about that, Susan, go right ahead.
Not a problem. This year will be a little bit different as the U.S. Census Bureau doesn't have as much funding to send speakers, so we're going to have a lot more local speakers. Having said that, I do have Kaneen Reese who will do 30 minutes on data.census.gov. So if you're wanting to learn those new things, that'll be there. Obviously, Mo will do our lunchtime presentation, and Robert Radigan and Jackie Miller will do the information about population and those statistics. But I have some exciting local speakers, TRD, HED possibly, and DOH. So early registration is now. Early registration is $65 for the day. October 1st, it'll go up to encourage people to register early. And then so we're excited. We'll still be at the same location, C&M Workforce Training Center this year. And I'd be excited to see all of you attend. So thanks for the few minutes to hype this, Mo.
Yeah, of course, no problem. And yeah, we of course we look forward to seeing folks at that event. It's always a good one. Uh, People from all throughout the state come, folks who aren't necessarily involved in this the forecasting program. So it's kind of a good opportunity to network with policymakers and people from different parts of the state or who work in different organizations, both private and public. So it's a good opportunity to kind of talk to other folks and see what they're up to and that sort of thing as well. So we encourage you all to attend. Um, my next announcement uh, is one that I'm sad to be making, but our unit administrator, Rayanne, as of next Friday, will be moving to a new position on campus, and so she won't be with BBER any longer. We will definitely miss her. She's been instrumental in the forecasting program and communications with you all, and actually helping me produce some of the stuff that I produce. And so, and in addition to all the other things that she does for organization, uh, administratively, and also actually as our kind of marketing person, marketing and communications person. So we're really sad to see her go. What this means going forward is probably from the near term, you're going to be hearing more from me in terms of just communications rather than from Rayanne, but it shouldn't change any of the continuity of communications going forward. So obviously, thank you, Rayanne, for all of your efforts throughout the years. We will miss you at BBER, of course, and I'm sure that the folks here will as well. The next announcement that I have, it's not as much of an announcement, but just to talk about our speaker for the day. So our speaker today is going to be Om Perumal. He's the Associate Vice President for Research at UNM. I think that it's having Om here to talk this afternoon is timely for a number of reasons. Importantly, obviously, UNM and institutions throughout the country are affected by policies coming from the president and the administration. And so I kind of wanted him to come and talk a little bit about that and talk about some of the things that UNM is doing to manage the uncertainty around, especially from the research side, that obviously is reliant on federal dollars and grants and those sorts of things, and what we're doing to try to manage what the sort of the uncertainties around what the administration is doing. So I'm excited to actually personally hear about that. I hope you are as well. Okay, so without further ado, I'm going to go ahead and get started. Again, thank you. August 1st. I can't believe it's August. This year has gone by so quickly. Um, Make sure here. Okay, so as always, I'm going to start talking about the US economy. I'm going to talk about the New Mexico economy, talk a little bit about the metro areas. I have a section at the very end where I'm going to talk about a few specific things, and then any questions or comments as far as this presentation is concerned. And then obviously we'll move on to Om after. Okay, so as always, here's my review of the national economy. Um, the economic data has been national economic data has been a little bit odd. Maybe it's expected, but still seeing the numbers come out is surprising, I think, to say the least. Specifically, the GDP numbers, I'll talk about GDP in a bit more at length, are expected, but still strange to see. The jobs data that came out this morning also, I think we're still trying to wrap our heads around. Maybe not super surprising either, but so the data that came out this morning in terms of jobs numbers, the number for the most recent month, so July data came out this morning for jobs, well, the number for the month of July, and the number of jobs added in July was around 75,000 or so, which actually came in below expectations. I think most analysts thought jobs were going to come in slightly north of 100,000, so a little bit below expectations. The thing that is more surprising, however, is that the months of May and June were revised down, and they were revised down substantially. Combined, they were revised down about 250,000 jobs. So over a 2-month period, that's a substantial downward revision. As a result of these revisions and as a result of the very weak month of July, the average for those 3 months is about 35,000 jobs added per month. Um, Things in general over that period were a little bit better in the private sector. The government sector came in negative in each of those months. And so there's that, but not super negative and not substantially better in the private sector. So the jobs numbers coming in, again, quite weak and revised down. The other thing that's been in the news, obviously, I'm sure all of us have seen, is the Federal Reserve in terms of their rate discussions. And the Federal Reserve elected to keep rates at the range of 4.25 to 4.5%, so kind of an average of 4.375, which is the same rates they've kept for some time, several months now, 6 months, 9 months, something like that. There had been discussion about, and a lot of push from the president for the Federal Reserve to actually bring rates down. We can obviously understand why that might be attractive, lowering borrowing costs and the like, especially from the perspective of the consumer's perspective, near-term consumer perspective, making things less expensive, et cetera. But the Federal Reserve, because was still concerned about price growth, which in the most recent month, prices increased, I think it was 2.7% or it was 2.8%. I can't remember the exact number. So still reasonably strong price growth. So the Federal Reserve elected to keep rates at the same range that they had been at. That said, I think it was one of the first times in quite some time where the actual folks on the committee differed in terms of their perspective. And so I think that there was a 9-2 vote to keep rates the same. Usually it's 11-0, I think. And I'm usually not in the weeds in terms of like the voting patterns of the folks that determine the interest rates. But I had read articles about how this was sort of a notable break. My guess, and this is sort of only slightly informed guess, is that when they meet again in September, given GDP, and sort of if you break down the numbers in GDP over the last couple of quarters, and if you look at the jobs numbers, and some of the other relatively soft data points, especially even over the last week or so, is that they'll probably, my guess, is reduce rates by a quarter point or so in September, which is actually a little bit faster than S&P expected in this particular forecast. S&P actually anticipated in their July forecast that the Federal Reserve would hold off until December to reduce rates. So I'm guessing it's actually going to come in that they're going to start reducing rates a little bit more quickly. Initial continuing claims for unemployment staying low. The rate this month ticked up from 4.1 to 4.2%, so up slightly. The U6 rate, actually, I forgot to change this number. I'm not sure what the number for the U6 is for the most recent month. I have to go look. But generally speaking, that rate has stayed low relative to obviously sort of, or relative to pre-pandemic levels. It's kind of in that range. Real GDP. I'll come back to this in a minute on my slide on GDP where I talk about the individual components, but GDP advanced in the most recent quarter. So the most recent quarter we have is that should be actually the second quarter, first quarter, the second quarter, 3%. And then in the first quarter, it fell 0.5%. So that's a typo. It should be the second quarter of 2025. And I'll show you a chart on that in a minute. West Texas Intermediate, before the jobs report came out, it was sitting right about $70 a barrel, slightly below. I looked at it right before I came on, and it had dipped down to about $67 a barrel. And so the price, and this is obviously given by some of the data coming out, sort of the weak jobs numbers and the like. Consumer sentiment, you remember from last quarter when I presented, we had hit sort of the second lowest level on record in terms of consumer sentiment. If you remember sort of where we were at that time, we were at the moment when the extremely high tariff announcements were made by the administration. And so consumer sentiment and the market actually, the market being kind of the stock market specifically, really pulled back over that period. Over the last couple of months, consumer sentiment and the market itself have both risen. And so whether that's that consumers have kind of brought the idea of tariffs into their thinking, or whether the effect of the tariffs just haven't really affected them appreciably yet, which is also probably true. And the fact that the administration has pulled back on the most draconian tariffs have all operated, and also data has been generally okay over the last couple of months, with the exception of the last week or so. And so consumer sentiment has come up from the very low lows that it had been at. Manufacturing still generally contracting. Services are still generally expanding. So the sort of bifurcation between manufacturing and services continues to be occurring. And then I have some concerns down at the bottom. These are not any different from what I've said the last several quarters. The last one that I have, and this has sort of been implied throughout, is just, kind of this cyclical economic slowdown. And so even stripping away some of the sort of negative macroeconomic effects from things like tariffs or what have you, I think the economy was probably primed for a slowdown after expanding so rapidly over the last, basically post-pandemic. And so that's sort of the last kind of bullet I have down there, the economic slowdown piece. But again, that's sort of been implied in S&P's forecasts over the last period of time. And Susan just mentioned the U6 is still at 7.8, so same rate as it had been last quarter. Okay, so inflation. So this slide shows CPI and also CPI when you extract out food and energy. So extract out the most volatile pieces of CPI. And what you'll notice is that for the overall measure in the most recent month, and I wasn't sure what the number was, but I couldn't remember if it was 2.7 or 2.8. It's 2.7, higher than it's been basically over the last 5 or so months. When you strip out food and energy, you'll see that price growth grew at 2.9%. So a lot of this is actually energy prices, and some of it is food prices, actually keeping things them coming down are sort of bringing the overall CPI measure down. When you strip those out, prices are looking like they're growing a little bit more quickly. So just as one measure, this is my anecdote for the day. I drive by a couple gas stations on my way to work, and the last 2 weeks, literally every day, I've seen the price of, per gallon of gas just go up, 10 cents, down 10 cents, up 15, down 20. It's been really erratic, like more than I've noticed in some time. And so I think things are pretty volatile for some of these measures. And, on a day-to-day basis, they probably sort of average out, but just, my observation, casual observation. I've shown this slide for the last, I don't know, couple of years. Obviously, job openings are down relative to the peak that we were seeing kind of mid-2022, down from where they were at that time. Obviously, this is a volatile series. It's especially volatile for New Mexico, just because things aren't really smoothed out as much. But openings are not as robust. However, on the other hand, there are substantially more job openings as reported compared to pre-pandemic periods. So higher than pre-pandemic, but much lower than sort of the recovery period. I've shown this slide for the last couple of years as well. This is sort of an index of global supply chains, basically going back to the pandemic era where supply chains and logistics chains were really kind of constrained for a whole host of reasons. Basically, since sometime around mid-2023, we've seen these supply chains really loosen, and that is the case through the most recent months of data that we have. Interest rates, obviously unsurprising given the fact that the Fed hasn't reduced them in some time, are still staying relatively elevated. So the slide that I'm showing up here is 30-year fixed rates, averaging generally over the last several months, with a couple of exceptions, between 6.7 and 6.8%. In general, these are rates that we were seeing at the beginning of the 2000s. Obviously, during the recovery period, these rates have been elevated, commensurate with relatively higher rates of the federal funds rate, but still staying relatively high. Generically speaking, the market, so S&P 500 and the NASDAQ, you can see, of course, how they move along in a similar fashion throughout the period that I'm showing up here. I know that you probably wouldn't even be able to see the declines that we're seeing today. Before I logged on, I went and looked at some of these markets, and they were down 1 to 2% after the weak jobs report. Obviously, these measures are hyper reactive to real-time data, probably, I would argue, overreactive. And what you end up seeing is some folks get sort of spooked. They leave the market, and then other people see that there's a deal to be had, and then the indices come up. And so I wouldn't be surprised if by the end of next week, or even early next week, there are recoveries of the relatively small losses that we're seeing today. It will not be anywhere near, I imagine, the losses that we saw during the tariff announcements. You can see the more recent periods of data there where we see these kind of negative spikes. But obviously, we've recovered completely from that anyway. So there we are. Okay, so this slide shows U.S. consumer confidence. This series is from the University of Michigan's, their Consumer Confidence Index. I have the series going back to January 2020, which is obviously the pandemic. You see the index hitting a high of 101. Higher numbers reflect higher levels of consumer confidence. You see the pandemic hit and that number plummet. And then you see it kind of level out a bit by early 2021. I think when folks thought that the pandemic was completely in hand, that came back up to an index level of 88.3. And then you see it really fall off of a cliff until mid-2022. Basically through the mid 2024, you see it improve. So consumers becoming more confident. And then since then, with some exceptions, you see things plummet. You see that level of 52.2 near to the right. Again, this is as a result of a couple of things. One, the GDP report had come out and showed a negative GDP growth for the first quarter, and also the tariff announcements that were particularly draconian, as I mentioned earlier, were first announced. Since then, confidence has risen in the most recent month of data that is available. And these are preliminary numbers. They end up getting revised a little bit, coming in at about 62. So still obviously well below pre-pandemic periods. But this level of 62 is kind of right around average for what we've seen during the recovery. This is a slide that's literally just copied and pasted from the conference board. This is showing their present situation and expectation index. The one that I'm going to focus on is the expectations index, the kind of blue line. And the only reason I'm showing this at all really is because basically, according to their measures and their modeling, anytime the expectation index falls below that kind of yellow horizontal line of 80, so when they have an index measure below 80, that usually means that we are primed for a recession over the next 12 months or so. What you'll notice is that basically from 2022 through the most recent month of data, we've been sort of, for the most part, at or below that 80 line, and we haven't technically been in recession. And obviously things spiked downward at the beginning of when those tariffs were announced and when that negative GDP number came out. Things have come back up, but we're still below 80. So if you go and read what they have to say about this, they'll say, you know, we don't actually expect that there's going to be a recession, even though our indicator says that there should be, at least given the current data. Okay, so as promised, some discussion of GDP. So as I mentioned, the first quarter contracted 0.5%, seasonally adjusted at an annual rate. The second quarter expanded 3%, seasonally adjusted at an annual rate. That last column where it says contribution, that is what of each of these elements is contributing to that 3%. So it's kind of weighted. These percentages are sort of weighted by how large they are to come up to this 3%. So if you look at the actual measures for the most recent quarter, at least in terms of the growth rates, not the contribution, but the growth rates, you'll see that consumption expanded 1.4%. That's pretty slow, actually, by historical standards. There's only two instances where consumption actually grew slower on the quarterly data that I'm showing, the second quarter of 2023, and also the quarter prior, the first quarter of 2025. If you kind of keep looking down, residential fixed investment contracted, non-residential fixed investment very slow, positive 1.9%. We keep looking down, the very bottom, federal government, state and local government, more or less growing in equal and opposite directions, pretty close anyway. If you look at the contribution side, I'm going to come back to exports and imports, and as well, I'm going to come back to the changes in private inventories. If you look back at to the contribution column on the right, of that 3%, it's consumption adding about 1 point to that. You see non-residential fixed investment adding about 1/4 of a point. Federal and state local government, almost a wash, slightly positive because state and local government sort of a bigger size than federal government. And so the relatively slower growth of that, even though we have relatively slower growth than federal government in terms of absolute sizes, contracts. The size of state and local government in terms of just dollars is larger. And so we have slight positive, but more or less a wash. Residential fixed investment, which I skipped over, brought things down 0.2 of a point. The things that I wanted to talk about, though, are changes in private inventories. What you'll see there is that changes in private inventories brought that top line down by more than 3 points, 3 percentage points, which is to say that basically if there were no change in private inventories, that top line GDP number would have been 6%. Obviously, that's not what happened. If you go back and look at the previous quarter, what you'll notice is that changes in private inventories actually was a positive about 3%. And so that would have effectively pushed up that top line by around 3% as well. And so, or 3 points, I should say. And the reason for that relates actually, I think, to the exports and imports line. If you look at the first quarter of 2025, what you'll notice is for exports, exports were basically flat, slightly positive. Imports actually rocketed ahead more than or nearly 38% seasonally adjusted. The reason for that is basically businesses knew that tariffs were on the horizon, and so they accumulated product in advance of those tariffs being put in place. What ends up happening mathematically, though, is that as imports go up, just the way that the math works out, as imports rise, GDP falls. And so just the calculation makes it so that when you have a period where you have high levels of imports, that's going to be a drag on gross domestic product because you have product that is not domestic effectively. And so what producers did was they accumulated a bunch of inventory because they knew that that same inventory, if they were to wait till the next quarter, was likely to be more expensive because of the tariffs. So to get ahead of that, they basically filled their inventories up. So fast forward to the second quarter, what you see is that exports actually declined a little bit, declined 1.8% seasonally adjusted. Imports also declined by more than 30% seasonally adjusted. Unsurprising, because producers had already filled their inventories the quarter prior, and also as the tariffs were kind of getting put in place or being expected to be put in place in that quarter, there were many fewer imports coming in. And so if you move all the way to the contribution line, more than 5 percentage points came in as a result of imports, and dragged down by about 2.2 points was exports. And so overall, to that top line, what you see, the thing that's really driving that is the fact that imports actually fell compared to the quarter prior. And so I'm saying all of this, and I'm spending so much time here, and I usually don't. But the reason why I'm in this particular case is because, one, obviously, we don't know whether a lot of this stuff has kind of worked through the process. And so we don't know what the third quarter is going to look like, whether there's going to be some sort of import or export weirdness like we saw in the first and second quarter that will affect things. So that's the first thing. The second thing is, if you actually to go and sort of strip out net exports and strip out the private inventories piece, what you would see is that basically for the first quarter and for the second quarter, the average rate of growth would be, rather than negative 0.5 of a point and positive 3 points, the average rate of growth that you would see would be somewhere in the range of about 1% to a little bit less than 1.5%. So in that ballpark. And so what we're really looking at when we strip out sort of this weird volatility that's being that is kind of coming sort of exogenously from the policy positions of the administration, is that GDP is growing about 1%, maybe a little bit stronger than that. So by any measure, regardless of the most recent quarter of data, pretty slow. And so that 3% number, the negative 0.5 of a point number, is probably a little bit of a false number. And the 3% number from the most recent quarter is a bit of a mirage. And so I just want to keep that in mind in terms of when people are thinking of this data. Okay, so this is I literally copied and pasted this slide for this chart from the Yale Budget Lab. And this is their estimates for effective tariff rates. And so what you see, basically going back to the beginning of the year, you can see very low US average effective tariff rates. You can see through April, you can see them really spike to over 25%. So this is kind of, I think, relative to all of our trading partners. You see them kind of come down as there was some waffling about the individual rates. And then you see things settling at a range between 15 and 20%, which is below those pretty relatively high rates that we were expecting in April and May, but much higher than what we were seeing, obviously, when the Trump administration came in. So they run this obviously through their models, and they try to estimate what effect these new tariff rates are likely to have on certain elements of the economy. So they estimate that the most recent tariff rates will increase prices in the short term by about 1.8%. So the price increases that we are likely to see of that sort of percentage can be attributed to the increase in tariffs. Reduction in GDP growth. So this is looking at their expectation from the fourth quarter of 2025 to the fourth quarter of 2026. So kind of year-over-year growth. Reduction in GDP of about 0.5 point. Lower payroll employment by the end of this year by about 500,000 jobs compared to what you would have if the tariffs, I imagine, would be at the lower rate where they used to be. And the unemployment rate elevated by about 0.3 point, all kind of like stemming back from these higher rates, kind of these higher import rates. Okay, so returning to employment data, I show this slide every quarter, basically just showing you what the levels we have for total employment. So number of jobs, 159,000 or 159 million, 159.5 million. The most recent month, actually, I think that is, I have to look and see because I typed down 159.9. I was doing it very bleary-eyed at like at 6:30 this morning, so not sure. But the point is that we're well above where we were prior to the pandemic. The UI rate is 4.2%. In terms of the private versus public sectors, so recovery driven mostly by the private sector, we're up about 6.5 million jobs versus the pre-pandemic period. If you were to go back and actually look at this slide from last time, what you would see is I would have said that private employment is up about 6.5 million compared to the pre-pandemic period. And that's because from basically from last quarter, we've added almost no jobs. I think it probably rounded up to 6.5 million jobs. This time it probably rounded down to 6.5 million jobs. I think the gain is something in the order of about 100,000 jobs that we've added since last quarter in net. So not a ton of jobs that have been added over the last 3 months. And so obviously we're sitting at very similar levels. In terms of government, you can actually see things start to tick down there, the purple line right at the end. The last couple of months, we've actually lost government jobs. And that obviously has a lot to do with, or at least something to do with federal government job losses and slowing of state and local job gains. What I will say is this, that undercounts what's going on with those federal job numbers. And so we all know about what happened at the beginning of the year, and it seems like it's been about 1,000 years since then. But the first few months of the Trump administration, one of their initiatives was to shrink the size of the federal workforce. And if you actually look at those data over the last several months, and I haven't added the most recent month into these numbers, but I talk a little bit about it going through at least June in the forecast narrative. But I think that we had lost something on the order of, I think it was like 65 or 70,000 jobs, federal jobs. But there are a lot of people who are still counted as employed who are technically on some kind of severance or who know that they're going to lose their job by the end of the year or what have you. So there are a substantial number of people in those categories. There are the people who took the offer to leave their position. So like kind of the don't know exactly what to call it. Something like a golden parachute, although it's not as golden as like a CEO. But basically, they're getting paid to work. They're getting paid basically to not work over a specified period of time. I think basically through the end of the federal fiscal year. So those people are effectively not working, but they're counted as working still. They're counted at least as having jobs still. And then you have the folks who are basically have severance at the moment, but they are still counted as having jobs too. And so you have these two categories of folks that basically starting at the beginning of next fiscal year will no longer be on the books, presumably. And so it'll be interesting really to see what happens to these jobs numbers when they are no longer employed on the federal books. Over the month job gains, I suppose the most important thing here is looking sort of the red line and the hashed horizontal line, that's 0% growth. I'm looking at year over year growth for each of the months going back to 2010. The most recent months of growth, obviously, we've seen slow. What we were seeing basically the beginning of last year was about 1.5% growth. We see that slow down through the most recent months of data over the last 18 or so months pretty regularly. And so now we're sitting about 1% year over year growth in the most recent month of data that we have. So it's slightly below, just rounds up to 1%. I think it's 0.96 or something like that. The participation rate and the employment to population ratio, notably, actually, if you look all the way to the right, for both of these measures, we've seen over the last couple of months them both fall some. It's a little bit hard to see, but we were sitting with the employment to population ratio the beginning of the year right around 60. That's come down nearly 0.5 point. In some months above 60%. Participation rate, we were sitting somewhere in the neighborhood of like 63, and that's come down as well. And so both of these measures kind of coming down in the most recent month of data that we have, lower than we've seen in a little while, actually quite some time. Wages are still continuing to expand. That's good news after wages got sort of eaten into as a result of high inflation during the recovery period. But we've seen real wage growth for 26 months in a row. This data that I'm showing on the slide here, the red line is annual growth. And so that black horizontal line is at 0% growth. We've seen 26 months, more than 2 years of actual real wage, annual real year-over-year wage growth. There are not data yet for July for this measure for the real numbers. What I will say is this, according to the data that came out this morning, wages went up 3.9% in July. And so we are likely to see our 27th month of real wage growth as well. Forecast assumptions. I won't spend a lot of time here because this slide has way too much text on it. This is in the forecast narrative in both the US section and the New Mexico section. So if you're interested in reading these assumptions and seeing a few more assumptions that S&P put this time in their forecast, then it's there for you to see. I think probably the things that are most important here are, one, their forecast was actually done technically before the so-called Big Beautiful Bill was put in place. What they argue, they being S&P, is that they basically anticipated what this was going to be anyway. And so essentially kind of the major elements and through lines were going to be. And so all going back to the end of last year. And so their forecast already includes effectively the major elements of the so-called Big Beautiful Bill. I think that's probably largely true, although I will be interested to see in the coming months how they adjust things, because they have specific information now about what this bill is going to do rather than sort of their assumptions. And I don't know exactly how their assumptions differ, the nuts and bolts relative to the pieces of the bill. So you can read through if you're interested the various pieces there. Monetary policy, as I mentioned, they assumed the first cut in December 2025. Just my semi-informed guess is that the first cut will probably happen before then, assuming that price growth doesn't accelerate anymore. That would just be my guess, but we'll see. And then at the bottom, obviously there is some discussion about trade policy as well and tariffs and the like. comparison of federal deficit. In this forecast, federal deficits are wider than last forecast. This is actually another measure that I would be interested to see next time, what they are anticipating. And that has to do with a whole host of issues. One is that they didn't have the budget bill in hand, and so they didn't know exactly what was going to happen with the revenue generating pieces exactly, or how much they would be lower in this budget compared to previous budgets, how much spending would be on net cut. And because there has been a move by folks in Congress, at least some folks in Congress, to reverse some of those spending cuts, and to see whether they are successful in that pursuit, whether these deficits will be wider going into the future. What I will say is this, and I'll talk about this at the very, very end a little bit. Estimates that I've seen from a whole range of sources, sort of more kind of middle of the road objective sources to even more partisan sources. The estimates suggest that the bill will increase the deficit by something, or the debt, I should say, by about $3 trillion. And so there's that. Okay, so changes in this forecast compared to April. This forecast actually revised a lot of things up, kind of the main variables that you would sort of expect to be sort of positive in a positive direction in the near term. So GDP growth has been moved up in this forecast in the near term. Employment growth has been moved up in the near term in this forecast, and income growth has been moved up in the near term, and actually in the long term in this forecast. What you'll notice in the forecast for New Mexico with employment growth and income growth is that they have both been moved up sort of commensurate. And so it's unsurprising because of the way that S&P's forecast filters through to the New Mexico forecast. So what you'll notice with employment is that in the near term, it's pushed up compared to last time. In the long term for employment, actually pushed down some. And so our forecast is pushed down a little bit over the long term as well. Things sort of wash out such that compared to our previous forecast by the end of our forecast window in 2030 for New Mexico, things end up about where they were before. And that kind of happens in the US forecast as well. Income growth pushed up, as I said, in the near term and the long term. Our forecast for income is pushed up as well as a result. West Texas Intermediate, CPI growth, and actually housing starts all pushed down in the near term. And over the long term, those indicators are mixed. And then just kind of just to point this out at the very bottom, these arrows aren't magnitudes. It's just kind of direction. So some things have been moved up just a little bit. Some things have been moved up or down a little bit more. And so just so you know that those don't represent sort of the relative sizes of these changes. Oh, and by the way, if you want to see the actual numbers and how they changed for an S&P's forecast last time compared to now, and a bunch of other indicators, it's in the narrative for the US section. And so you can see how these numbers are actually different on an annual basis in the April forecast versus their July forecast. Okay, so real GDP forecast, April versus July. You can see in the near term, these numbers, these forecasts pushed up compared to last time. So you've got that, and a little bit lower in the out years, as I already mentioned. Employment, a very similar story, pushed up from last time in April. They actually had a little bit of negative employment growth in their baseline scenario. They don't anticipate that this time. Very slow rates of positive growth basically throughout the forecast. When we get into 2029 and 2030, we're seeing growth of around 3 to 4 tenths of a point. So very slow rates of growth in this forecast compared to last time. That said, their estimate, I'll show you in a minute slide, but their forecast for calendar year 2025 is for annual growth of about 1%. And given the most recent months of data that we've seen, of employment, so the data that came out this morning, we're sitting right now at right about 1%. So these represent very slow rates of positive growth. So that's kind of the anticipation. Forecast by sector, again, this is from their July forecast. So you can see the industries that are anticipated to add or subtract jobs. Obviously, the red numbers in parentheses are contraction. The black numbers are addition. This is basically looking at, in thousands, how many jobs are added or lost each year by industry. And so you can see in construction, you can see in trade, transportation, and utilities, at least in the near term. In the near term, leisure and hospitality, other private industries. So the other private industries not included here, with the exception of the last year, mostly adding jobs. What I'll alert you to is in the near term, professional business services actually brought down. And so a weaker account for professional and business services, well, a weak account, I should say. I don't know if it's weaker than last time, but a weak account of professional business services losing between 25 and 2027 about 900,000 jobs in this forecast, and then not gaining them back until basically the end of the forecast. We also see manufacturing throughout the entire forecast window losing jobs. And this isn't substantially different from what we've expected in the past. Actually, this is an industry where we've expected manufacturing to lose jobs going forward for some time. I will say that in the budget bill, there are some tax benefits to manufacturers and specifically for construction of manufacturing plants. So I think that is a specific measure, a specific thing that the administration is trying to do to, at the very least, staunch some of this bleeding. But I don't think, at least according to what most folks think, that is going to be a growth industry moving forward, at least in terms of jobs. You can look at the very bottom down there, government. So still adding jobs in 2025, actually contracting in 2026, when basically state and local governments slow the rate of growth. And more than that, we see losses in federal government workers. And very slow growth thereafter. And down at the bottom, we can see the annual rates of growth. 2025, about 1%, 2026, 0.3, 2027, 0.3, 2028 slips to 0.2. And then 0.4%, 2029 and 2030. I think over 2026 and 2030, it's about 0.3% per year with some slight variation from year to year. In this particular forecast, the U3 rate actually should be, it's lower. I didn't change the thing. It's been bouncing back and forth between slightly lower and slightly elevated, basically sitting around 4.5% to 5%. Personal income growth, not much different that you can see on this particular slide. If you look at the annual data, you'll notice that things actually got pushed up a couple tenths of a point in each year. Disposable income, this shows it better because we're looking at year-over-year growth rather than quarter over previous quarter. And so year-over-year growth, we're seeing in the very near term more rapid rates of disposable income growth. Oil and gas spot prices. The price of oil actually got brought down in this forecast by about $10 per barrel over the next year compared to last time. Last time in 2025, they had anticipated that the price would be about $64 a barrel. In this forecast, they're anticipating this year and into next year about $55 a barrel. And then you see about in 2027, then the two lines start to merge and grow at similar, or basically be at similar rates. In this particular forecast for Henry Hub, the price is pulled down some. What I will say is that basically this flips back and forth every quarter. And so this particular quarter, they've moved things down. I wouldn't be surprised if next quarter looks more like what we saw 3 months ago. That's just kind of the way this pattern has been working. Consumer price index. This is looking at CPI-U and then the core CPI. So CPI-U is basically everything. Core strips out food and energy. And what you see is that prices are expected to stay above that 2% threshold until right around 2027, when we're sitting just marginally above 2%. Again, incidentally, if you go look at the that comparison sheet in the forecast narrative in the US section, you can see how growth is different in this forecast compared to last forecast. If you're interested in seeing how CPI is different now compared to 3 months ago. Housing starts, as I mentioned, also pulled down a little bit in this forecast compared to last time. So there we are. Interest rates. So again, this assumes that the federal funds rate gets brought down for the first time in December. I'm expecting things to happen about 3 months earlier. We'll see. And I expect that S&P will think that too, but again, we'll see. Okay, so moving on to the New Mexico review. So the New Mexico current economic situation data for New Mexico has continued to be pretty solid. So the data pieces that we have obviously is we have QCW data through the fourth quarter of 2024. So obviously that's fairly delayed, but that's what we have. We have gross state product data for the first quarter of the year. We have, which is staying kind of reasonable, sort of in a reasonable level in terms of growth rates. We have CES kind of other employment data. So we have the survey-based employment data, which is we have through June, which is also staying relatively strong. Maybe my guess is actually it's overstated actually for the last at least 3 months, if not for the first 6 months of the year, a little bit. But we'll see. And the unemployment rate staying moderate. We still are producing substantial volumes of oil. In fact, the most recent quarter of data that we have for oil production is the second highest volume of oil produced by the state, second only to the quarter before that. And so the state is producing tremendous volumes of oil. That said, rig counts have fallen quite a bit. They've fallen by about 10%, if not more, over the last kind of month to two. And so we're sitting kind of in the low 90s in terms of rig counts, whereas we were sitting in the low hundreds basically 3 months ago, 4 months ago. And so most pieces of data, most kind of data series seem to be relatively strong for the state. But our expectation, obviously, similar to the expectation for the US, and especially in 2026 and beyond, is that things will slow. So at the moment, as I mentioned, we have data of gross state product for New Mexico and for all of the other states. And so this is, again, through the first quarter of 2025. What this is showing is each state indexed back to their respective fourth quarter of 2019 and looking at what percentage we are above or below in each of the successive quarters. New Mexico is sort of the middle of the pack. About 20 states have higher relative to their respective fourth quarters of 2019, higher percentages relative to that number. We are about 11% above where we were in the fourth quarter of 2019. 20 states are more than 11% above where they were in their 2019 quarter four. So not horrible, actually. So somewhere right in the middle of the pack. But it's not exactly like we are at the top of the pack. Change in labor force by place. So if you're interested in seeing how labor force on a year-over-year basis has changed, you can see these sharp decreases at the beginning of 2020, at the beginning of the pandemic, I should say, in 2020, where basically every part of the state labor force contracted pretty mightily. Basically, starting beginning of 2021, for the most part, we've seen growth in labor force. And so right at the moment, if you kind of add all of the pieces together, we are about 3.1% above where we were prior to the pandemic in terms of labor force levels. That isn't too far off of where we are in terms of employment. We're somewhere in the neighborhood, depending on which series you look at, 4 to 5% above employment. I should be specific. Sort of QCW or CES employment. So not household survey numbers like the labor force data show. So kind of a different data series, but by a different measure, measuring something slightly different. We're at similar levels, actually slightly above these labor force kind of relative numbers relative to pre-pandemic levels. And basically every part of the state, for the most part, is continuing to add labor force in the most recent data. I will say this, these numbers, they do get revised. And so if there are new accounts to these data, new sort of modeling methodologies and the like, we may see things actually be adjusted moving forward. One of the things that I thought I had in this presentation, but I must have taken out, maybe it's coming up, but is a historical comparison between the US and New Mexico in terms of like labor force participation rates. And the New Mexico labor force participation rates had been revised back since 3 months ago, since I kind of pulled the data again, most recently 3 months ago, and I pulled the data again this week, and they've been revised back going back to like the 70s. And so there are adjustments to these data based upon a better understanding of the series and the like. Oh, so yeah, actually, here we go. So labor force participation, this is, and by the way, they weren't revised a ton, but they were revised. Labor force participation, New Mexico versus the US, just to give you an idea. And this is something I've talked about for some time, that there has been a differential between New Mexico and the US in terms of labor force participation rates. So the red line is New Mexico. The blue line is the US. They're both referenced to the left axis, and that's looking at the actual rates. You'll see, again, New Mexico is below the US throughout. The gray kind of area is looking at literally what is the difference between those two lines. So subtracting New Mexico away from the US, just to show you sort of how much it's grown over time, how much and how obviously it's volatile. But if you go back, and that's referenced to the right axis, and you can see the differential between those two lines a little bit more clearly. It's obviously kind of almost zoomed in because the axis is, starting from 0 and only goes to 7 versus the left axis going from 53 to 69. And so there obviously is some amount of visual manipulation, but just to allow you to see how things have changed over time a little bit better. And so what you notice is that from 1976 through basically the Great Recession, you see the differential sort of grow at a sort of regular rate through time. During the recovery from the Great Recession, however, at least to my eye, it seems like the differential really expanded. And so now we're sitting in the range of 4.5 to about a 6-point difference between New Mexico and the US in terms of the labor force participation rate. That is to say that the labor force participation rate in New Mexico is about 4.5 to about 6 percentage points lower than it is in the US. Okay, so this slide compares New Mexico versus all the other states in terms of employment through June 2025. And this is looking specifically at the CES data series. And relative to each state's February 2020 level, that particular level was chosen because that's the peak for New Mexico. So that's the month that I picked to go back for every state to index to. And the story I tell every quarter is New Mexico wasn't hit as hard at the beginning of the pandemic or at the beginning of sort of a recession, kind of like how it always isn't usually, or it's generally speaking, not hit as hard as other places. But then you see the recovery really trail other places at the very beginning, other states bouncing back much more quickly. But if you kind of look at the series over time, whereas a lot of the other states kind of started to level out, New Mexico continued to just sort of plug along. And maybe that's kind of the just what we do is we just kind of, as a state, we don't see these really low lows. We don't see these really high highs. We just kind of chug along. And we get to a point where we end up sort of middle of the road, which is sort of where we are here. We're slightly above the middle of the road. 18 other states have had higher or kind of stronger recoveries in terms of the most kind of comparing the most recent months to, or the most recent month to the state's respective February 2020 levels. New Mexico is about, as I mentioned, 5% above in terms of employment levels compared to that February 2020 level. As I mentioned, it might be the case that these are a little bit elevated compared to, and this is just kind of a guess based upon some of the other data points and based upon a slowing of the US data series and the like. So I'm wondering if that's just a little bit high compared to where it actually is. And in fact, if you look at our forecast for the first and the second quarter of our estimates, I should say, projections, if you will, of the first and the second quarter of 2025, we're below what the CES growth rates are because we think that they're just a little bit higher. We think CS is a little bit higher than actually will come in. And that's informed by, among other things, the fourth quarter data for QCW actually came in a little bit weaker than anticipated. And so those first two quarters are kind of brought down relative to CES. So you'll notice that 2025 is, I think, a little bit lower in this forecast than our last forecast for those reasons. Or actually, I think it's above, but just not as much above as you might have otherwise anticipated. Other surrounding states, Arizona about 9% above, Colorado about 6% above, Oklahoma 6%, Nevada 9%, California about 2% above their respective February 2020 levels. Okay, increased field oil presence and production. Again, I've shown this slide for some time. We're still producing more than 16% of all the oil produced, field oil produced in the US. We still have more than 16% of all rigs that are operating in the US are operating in New Mexico. The thing that's perhaps a little bit concerning is that oil rig counts are down. And so we are down to levels that we haven't seen in a little while. We've been sitting sort of at or above 100 for any given month, basically going back the last, I don't know, 18 months or longer, sitting at somewhere around like 91 to 95 rigs, or 90 to 95 rigs is lower than what we've seen in some time. So that's a little bit of a concern in terms of, are we going to actually be able to keep up the production that we've been seeing over the last, and the increases in production that we've been seeing over the last couple of years. In this particular forecast, and actually has been the case for some time, we're not really expecting huge increases in production. We're expecting over the next several years that production has kind of topped out. And a lot of that really is informed by these rig count numbers. And unless we start seeing them kind of increase, it's hard to anticipate that we're going to see higher volumes of production over the next couple of years. Higher volumes meaning, in this case, increases in production. We do expect that we're going to continue to produce a lot of oil and maybe near to kind of record levels, but we're not expecting to continue to break records year over year any longer, unless we see changes in rig count numbers. What I will say, and as I mentioned in the forecast narrative, is that the Trump administration obviously is interested in the US, just generally speaking, producing more oil. And so that actually is some upside risk in this particular industry, in the kind of the oil production and gas production pieces. And so there's also that. Move towards more efficient production, meaning we're able to produce more oil with basically fewer workers. So I won't kind of belabor the point there, but that's kind of where we are. Housing sales and prices through June 2025 versus through June 2024. So looking at the first 6 months of this year compared to the first 6 months of last year, these data are coming from the New Mexico Realtors Association. What you'll notice is that statewide sales are up 6%. You see where these sales are up, especially in places like Albuquerque. Actually, sales are up in Santa Fe. Sales are up in the rest of New Mexico. Sales are flat to negative, at least in the first 6 months in places like Las Cruces, MSA, Farmington, and Lee and Eddy counties. median price is up compared to the first 6 months of last year by 3%. I was actually kind of surprised when I saw this data that sales are up. I'm kind of surprised that I saw that. I kind of expected the sales numbers to be not quite as robust. And I expected, well, I don't know what I expected in terms of prices, but the rate of price increase is definitely slowing. You can see that the Albuquerque MSA prices increased, Farmington prices increased, Leonetti. You see it pretty much everywhere. Price even increased, sort of median sales price even increased in Santa Fe. And so the median sales price is over $600,000. Statewide sales totaled just a shade under 10,000 units through the first 6 months of the year. Median sales price is up to $350,000. The Greater Albuquerque's Realtor Association through June 2025, sales are up 4%, so a little bit below that statewide 6% number. Median sales price is up 3%, so similar to the state, but up to $365,000. So a little bit more expensive than sort of the state median number. Taxable gross receipts, and this is just looking at the first quarter of 2025 versus the first quarter of 2024. You can see the industries where the taxable gross receipts were particularly robust in the quarter. In aggregate, taxable gross receipts up $1.4 billion, or by about 6% compared to the same quarter a year before. Coming from most industries: construction, professional and technical services, other, wholesale trade, retail trade. So most things really adding there. Mining up this time. I think last time it was actually negative, but up about 92 million. But most things up. In terms of the places of the state where you're seeing positive numbers, again, sorted from largest to smallest. I don't have every county on here. The counties that aren't shown are in the line that says other. That was about 52 million higher than the same same quarter year prior. That's a little bit of a misnomer, to be honest, in a way, because it includes some positive and some negative in there. But in any event, the places really adding to the bottom line: Lee, Lincoln, Eddy, San Juan, perhaps surprisingly some more non-metropolitan places, although you could argue Lee and Eddy, given the size of those places, they are, by most other definitions, metropolitan areas. San Juan obviously is a metropolitan statistical area. Then we get into Doña Ana County and Bernalillo County, and really kind of the Albuquerque metropolitan area. So there you have it. You can see on the right that the annual growth rates. Obviously, Bernalillo County, it's the largest place in terms of raw size, so that grew only 2%, even though it was one of the larger places that highest dollar amounts in terms of growth, or increase, I should say. State recurring revenue, and this is straight from the LFC. This is taking their data. This is through February 2025, so July 2024 through February 2025. Which elements here are adding to state recurring revenue? So the ones really kind of pulling the load here: GRT, selective sales, corporate income tax, and investment income. Recurring revenue up about 266 million compared to the same months a year ago. The things that are pulling things down: personal income tax, mineral production taxes, rents and royalties. So really from oil and gas production for the most part, and other. And so this is a reversal, obviously. You had things like mineral production and rents and royalties over the last several years really pushing things up. And so the fact that those are in negative territory now is suggestive of the idea that things are sort of flattening out in terms of the revenue picture. Okay. Job growth and loss by sector. And so this is looking at all of the industries for the state of New Mexico. In the left panel, I'm showing the industries and for basically 2024. So how many jobs were added or lost in 2024 versus in 2023. In the right, I'm showing starting in basically going from 2019 to 2024. So pre-pandemic versus the full year of 2024 data, which we now have, which industries have added or contracted the most jobs over that period. And it's sorted obviously by the right panel. Both of these graphs are. So over the longer period from 2019 through 2024, the industries that have added the greatest numbers of jobs: professional and technical services, healthcare, transportation, retail, construction, state government. And then you can kind of read them all the way down. One of the ones that's interesting, because as we know, local government was hit so hard for a longer period of time than a lot of other industries, and was one of the laggards really in terms of recovery, at least out the gate, is now almost 1,000 jobs above where it was prior to the pandemic. So kind of find that surprising. If we scroll down, well, or look down to the bottom, mining still about 2,200 jobs below 2019 levels, which to me is surprising because we are so far above where we were in terms of oil production that it's kind of it's crazy, really. It's shocking when you look at these numbers, how much above we are now compared to 2016 levels, 2017, et cetera. Agriculture down nearly 1,800 jobs, finance about 730, management, et cetera. So you can see these positives and negatives. On an annual basis, kind of looking back at the left panel, you can see over just the last year compared to the year prior, which industries were adding jobs, which ones were kind of contracting. You see local government adding the greatest number and state government adding a good number of jobs. The healthcare industry adding a lot of jobs, professional and technical adding a lot of jobs. Obviously, healthcare, local government in particular, and local government in particular are very large in terms of their bases. And so these sort of end up being sort of modest rates of growth, but the numbers of jobs are obviously relatively large. If we look at where things contracted, retail dropped a few jobs, finance and agriculture dropped some jobs as well. If you compare 2019 through 2024 sort of in aggregate, the state is about 4% above where it was in 2019, so about 34,000 jobs. Most of those jobs are in the private sector. Private sector grew about 4.3% over that several year long period. Government advanced by about 3%. As we know, and as I mentioned a couple times, we have CES data through June 2025. This is looking at June 2025 data, and I'm subtracting away from that the data for each of these industries going back to January 2020. And what you can see is by these sort of broad industries is, most places have done relatively well in terms of adding jobs. Health and education, if you look to the right, professional business services, construction, government, transportation, retail, all adding more than 4,000 jobs over the last, 5+ years. You can see some industries still kind of in the negative, though. Other leisure and hospitality, mining, and wholesale in sort of negative territory. The hashed line that you see there is the 0% line. So you can see how fast each of these industries sort of grew. That's referenced to that right axis. So that kind of orange line there. No, it's not the easiest graph to look at, but you can see that kind of obviously controls the relative sizes of the industries. So you can see things like transportation and construction grew very fast and actually grew at very similar rates, but transportation added fewer than half the number of jobs that construction added. So kind of you can read it that way. Okay, so moving on to the outlook portion. So the outlook for the state 2025 through 2030, employment growth remains solid in 2024. We're expecting in this year employment to slow to about 1%, kind of in the range of 0.9% to 1%. I think S&P's forecast for this year is about 1.1%, at least at the moment. We'll have to see when they come out with their next forecast, especially given the weak jobs numbers that came out this morning and their downward revisions for the last couple of months prior, what their expectation is for employment. They may bring it down. We'll see. National slowdown begins to weigh things down beginning in 2026. There's still no recession in the baseline scenario. For our forecast versus the US forecast, we grow very similar rates to the US forecast. You'll see that we are about 1/10 of a point below them, but basically below the US forecast. If you remember last time, we were about 1/10 of a percent above their forecast. Now we're about 1/10 of a percent below. Not much kind of really different in terms of our expectations. We just don't get pushed up quite as much in terms of their thinking now because of the particular industries that they're expecting to grow and how those play out in New Mexico and the relative sizes of those industries in our state. The pessimistic scenario has job losses in 2026 through 2028 and then grows a little bit faster than the baseline thereafter. I'll come back to that sort of near the end. Pessimistic 2 scenario actually turns negative kind of right out the gate in 2025 through 2028. And then we get a slow recovery sort of at the end of 2028 and thereafter. We lost about 90,000 jobs at the beginning of the pandemic. The QCW data that we have through the fourth quarter of 2024 is solid. We're probably in the neighborhood through the end of the year of about 4 to 4.5% above where we were prior to the pandemic. The CES data is somewhere in the neighborhood of like 5 to 5+% of where we were before the pandemic. And that's part of why I think that CES might be a little bit elevated because I don't think that we are quite up 5.5% or so above pre-pandemic levels, but I could be wrong. Employment grew 1.5% in 2024, projected growth of about 1% in 2025, slows to about 0.2% in 2026, increases a little bit to 0.3% in 2027. New Mexico exceeded 2019 employment levels by 2023. By 2030, about 56,000 jobs above 2019 levels, somewhere in the neighborhood of 6 to 7% above 2019 levels. In this forecast, income growth particularly solid, 2025 through 2029, 4.9% per year. This is an upward revision commensurate with the US forecast for employment being pushed up. So our comparison in this forecast compared to last time, pushed down a little bit compared to last time, as I mentioned, not appreciably so, but again, yeah, pushed down a bit. Projections by industry 2025 and 2026. So this slide is actually showing annual gains or losses by industry in 2025 and annual gains or losses by industry in 2026. The blue and the red are just showing the year 2025 and 2026. They're not showing a positive or negative number. I know sometimes I use red to show negative numbers. This time I didn't do that. It's just I used the sort of the automatic formatting that Excel gave me here, and it's just showing the respective gains or losses by any industry. The numbers that you're seeing sort of to the right or the left of the bars are if you were to add the blue and the red areas together, what you would end up with. And so, for example, if you go down to where it says retail, you'll see you have some negative area and you have some job losses in 2026, a little bit of job gain in 2025, and that nets out to a slight job gain over that 2-year period of 331 jobs. The reason why I'm doing this is because I wanted to show both sort of what the increases or decreases were looking like by industry in 2025 and whether things are expected to reverse for some of these industries in 2026 or stay on a path that we've seen in the past or just slow down, frankly. So at the top, we have healthcare adding a good number of jobs in both 2025 and 2026. Accommodations adding a good number of jobs in both years. And then obviously we're kind of slowing from there over that 2-year period. And incidentally, if you couldn't tell, obviously this is sorted by this 2-year sum of jobs. So over the 2-year period, healthcare is adding the most jobs, accommodations, second most jobs, local government, third most jobs, etc. If we scroll down to the very bottom, what we see, before I get there, what you'll see is professional and technical services still adding jobs in New Mexico in 2025, but pulling back in 2026. If you remember when we looked at the US, we actually saw job losses in professional and technical services, I think even beginning in 2025, but for sure in 2026. And so sort of the US picture pulling the New Mexico picture down. And sort of that's sort of what you expect based upon the integration between the US forecast and the New Mexico forecast. If we look down at the bottom, federal government, obviously expectation for job loss in 2025, as I talked about at the beginning of the presentation, the U.S. government wanting to contract the federal workforce. So we're seeing job loss in 2025, and that actually accelerate or come into starker relief even in 2026, and being sort of the industry that pulls things down the most. Administration, the second greatest number of lost jobs over the period, and info pulling things down as well. Oh, and actually, surprisingly, you don't really see this much too many other places. The mining industry has seemed like, obviously, as I mentioned, drilling rigs counts have come down. It seems like mining employment might also be softening as well. And so the expectation is that there are very small losses in the mining industry in terms of employment. As I mentioned, there is upside risk there based upon what the administration does and how it tries to incentivize oil and gas production over the next, couple of years. So just kind of keep that in the back of your mind as well. Okay, so using 2026 as the base year and going through 2030, which industries are we expecting to add the greatest number of jobs and lose the greatest number of jobs? Unsurprisingly, healthcare adding, because it's such a large industry and because we have such a shortage in this industry of all levels of healthcare workers throughout the state. And in part because, among other things, there has been a push, a concerted effort being made by UNM and elsewhere to train more healthcare workers. Obviously, from UNM's perspective, they are healthcare workers along the lines more of things like doctors and nurses, other trained healthcare workers as well. But this includes other healthcare workers as well that may not have that kind of higher level advanced training that this state is really trying to kind of push. Because again, as I mentioned, we have such a shortage in the state of those types of workers. Administration. So if you remember from the last slide, we saw admin really contracting over the period 2025 and 2026. This is sort of a bounce back from that, adding a good number of jobs 2026 through 2030. You can see mining actually adding a good number of jobs as things sort of flatten out in terms of production and in terms of needing to actually continue to drill to stay at a particular level. And so a decent number of jobs over that period after a very soft, to say the least, 2025 and 2026. You see local government, state government still adding jobs. Looking down to federal government, actually gaining a few of those jobs back that were lost in 2025 and 2026. If we look down all the way at the bottom, accommodation, this is national trend. And so expectation of loss in accommodation and food services, same thing with retail trade and manufacturing, all pulling things down. Okay, if we look at our best performers 2030 versus 2019, which industries added or are expecting to add the most jobs over this longer period of time? So healthcare adding nearly 20,000 jobs over that period. Obviously, a lot of those are already in the books. And so we're still expecting a good number of jobs to be added really this year and throughout, but a good percentage of that have already been added. Same thing with professional and technical services, same thing with construction, same thing with transportation. This is a little bit misleading because in general, most industries are expected to only grow if you look at for basically 2026, starting from 2026 through 2030. If you look at these rates of growth for most of these industries, they're very, very slow, the expectation. And so a lot of these are, again, sort of already in the books, but just to give us an idea of where this sort of around 60,000 jobs in 2030 before compared to 2019 are coming from. This is sort of the distribution. Okay, comparing the New Mexico forecast to the US forecast, as I mentioned, in this particular forecast, we run a little bit below, about 0.1% below the US in 2025 and 2026. And then we kind of merge with the US forecast in 2027 and actually grow slightly faster than the US 2028, 2029, and 2030. If you remember from last time, this particular slide, I was showing the US projection actually going into basically negative territory or 0% growth in 2026 and very low rates of growth, even lower rates of growth in the very near term. S&P actually pushed those numbers up in this forecast. As I've said before, it'll be interesting to see what they do given the most recent numbers in their next sets of forecasts. Okay, so comparing New Mexico with the other states, as I mentioned every quarter, there are other BBERs or other organizations or entities in other states, or there's other entities that actually project various variables or different variables, economic variables. And the university or Arizona State University, they have a thing where they basically ask these various entities that project these variables what they think the growth rates are going to be for those variables, and they do a consensus forecast. And so I have the actual link there at the bottom if you're interested in taking a look. What you can do if you go to their website is you can actually look at who the consensus forecast groups are. That is to say, if you were to click on like the Arizona one, you can see which entities contributed to the Arizona forecast, which entities contributed to the Colorado forecast, and the like. And you can see actually what their projections were for particular variables. What I'm showing up here for the states other than New Mexico and other than the US are those consensus forecasts. So literally an average of their forecasts that is posted by Arizona State University. And so you can see how the forecasts are different. I will say this. I'm not sure that the forecasts for those other states have really been updated for 2026, especially for employment. So for example, Arizona has a expectation for 2026 of 1.9% employment growth, Texas 1.7%. These seem a little bit robust to me, given that we are expecting that 2026, especially 2026, is going to slow down. We know that these states have generally grown faster than the US on average, but it seems like given S&P's expectation for 2026 of only being 0.3 of a point, and our expectation for 2025 being 2 or 2026 being 0.2 of a point, that they are a little bit overzealous in terms of their expectation. I also know, and I presented on this some time back, but the other states, they tend to overestimate what their growth is going to be. And so there's also that. And I don't know that they pay attention as much to the following year. And in addition to that, because it's sort of a consensus forecast, if not everybody updates their forecasts at the same time, it might be the case that an older forecast with older information and older thinking about the evolution of the economy are sort of incorporated into their consensus forecast for those places. So some of the places may think, oh, well, we're actually going to grow at 0.5 point. But if you still have a couple places saying, oh, no, we're going to grow at 2.5%, then those averages are going to obviously get pulled up. So there's that. In terms of the income numbers, you see for New Mexico, both years about 4.9%. Actually, that falls roughly in line with the other places. And these numbers generally haven't changed that much for these other places over some time, but gives you an idea of how we stack up to elsewhere. Our forecast for personal income annually by component. So you see this is each of the components addition in these cases, I guess, is every component of income is adding, showing up here is adding to total personal income for each of the years shown here. So if you were to go back to pandemic era, obviously we'd have some of these bars go below the zero line. We don't have that in the most recent historical data. or the forecast. You can see the rates of growth. Obviously, these are the scaling is pretty compressed there. It only goes from 4.2% to 5.2%. So these differences look a lot larger than they in reality are. But averaging about 4.9%, especially through 2029. Things slow in 2030 to 4.5%. And this is just follows the trajectory of the US forecast. The things that are really kind of pushing growth up and in terms of sort of the growth rates actually are things like, if you look at 2027, kind of picking up to 5.1% in this particular forecast, kind of inexplicably investment income. And so this, again, just is sort of our estimate based upon what's happening in the US projection. I will say this as well for this particular series, is that this one has been pretty volatile in the US series. And so that has made this kind of move around quite a bit for the New Mexico forecast as well. So if you were to go back to our last forecast, instead of being in about a range of 4.8 to 5.1% per year, we were more in a range of, I think, 4.5 to about 4.9% per year through 2029. And so, and if you were to go back 3 more months prior to that, to January, our January forecast, it would look more like the one that I'm currently showing on the screen. And so I think that they're having a little bit of a challenge, and this isn't unique to S&P. I mean, this is forecasters in general trying to understand what, obviously what the labor markets are looking like and what wage and salaries are going to look like. But even more challenging at the moment, I think, are things like investment income and seeing the volatility of the markets, or even transfer payments and the expected pullback of things like Medicaid payments and the like. And so they're having a bit of a challenge, I think, getting their arms around a trajectory for this particular variable. And not to mention the fact that, especially for New Mexico, this is a variable that is notoriously revised. And so and substantially revised. And so, we'll see moving forward how our thinking evolves. Okay, so alternative scenarios. I don't want to kind of belabor stuff here on the alternative scenarios, except for to say, in terms of S&P's assessment of the alternative scenarios, they have adjusted their odds of the scenarios. So the baseline is at a 50% chance. The pessimistic is at 25%. The optimistic is at 25%. Before, we had the pessimistic at 35% and the optimistic at, I think it was at 15%, and I think the baseline was 50%. In any event, the bigger issue is that the pessimistic scenario has been brought down from 35%. That said, in this particular forecast, the pessimistic is more pessimistic than it was last time. And actually, surprisingly, the optimistic scenario, in terms of the levels, are more optimistic than last time. And so what you'll notice, especially when we get to the New Mexico section, the Mexico part, you can actually kind of see the optimistic scenario a little bit, whereas before they were almost completely overlapping. The pessimistic scenario is actually pretty pessimistic too. So just a couple of different things here. So real GDP forecast on the left, these are real dollars, kind of real billions of dollars. Optimistic scenario, you see things kind of pick up in terms of real dollars. You see the baseline scenario just kind of move ahead. You see the pessimistic scenario kind of level out a little bit in the near term and then turn the corner. You can see the rates of growth are actually, if you were to compare to last time, there's more of a bump on the optimistic scenario than last time. They were much closer together. And you see relative to the baseline scenario, the pessimistic scenario fall more. That said, none of the years actually end up in recession, although you do end up with technically a 2-quarter recession in the pessimistic scenario. It's just not shown when you average out the entire year. If we look at the US employment growth, we see in this particular forecast, US employment growth for the baseline scenario sort of moves ahead. Optimistic, slightly better. We can actually kind of see it a little bit better than we have over the last basically 2 years. Pessimistic scenario actually dips down quite a bit more relative to the baseline. Comparing this forecast to last forecast, so just nationally, this forecast is basically one of the stronger ones that we've seen in terms of levels, perhaps surprisingly. If we look at both GDP and we look at employment, they're at a higher level for both of those variables. And playing that through to the New Mexico forecasts, we have our baseline forecast. This is in thousands. We have our optimistic forecast, which you can actually kind of see, which is, oddly gratifying, although it's not like it's this huge increase compared to the baseline, but you can actually see it, and it's better sort of throughout. You see the pessimistic scenario, you end up just kind of losing jobs and not really starting to turn the corner until the end of 2028. And it takes it basically until 2030 to get back to the peak that we are going to be reaching this year. In terms of the pessimistic 2 scenario, we basically end up in a situation where you just don't end up recovering back to levels that we were seeing actually back in 2024, which was the peak in that particular scenario. As I mentioned, in this particular scenario, the wheels kind of fall off at the second half of 2025. And so we end up losing jobs for the year in that particular scenario. So we just kind of end up in a malaise. We look like what we looked like after the Great Recession, and it takes some time after 2030 to really sort of move ahead. Okay, I'm going to go very, very quickly through the alternative, or not the alternative, the MSA section, because I want to talk about the stuff. I have some stuff at the very end that I want to discuss. One of the things that you'll notice, especially for the larger places, and this is QCW data that we have through the fourth quarter of 2024, things are slowing in many of the places. And the fourth quarter is either the smallest number of jobs or like near to the smallest number of jobs for most of the places that I'll show. So Albuquerque slowed quite considerably in the fourth quarter. That said, one of the things that's been happening with the QCW data, and it's been noticeable, and it hadn't happened really before the pandemic, but has been happening during the recovery, is that the QCW data are seeing some revisions, and the revisions tend to be or have been fairly noticeable. And so it wouldn't surprise me if we see these numbers actually revised up just a little bit. And so anyway, Albuquerque, very slow fourth quarter. Las Cruces, the smallest number of jobs over the period that we've seen during the recovery period. Santa Fe essentially moved sideways, the slowest rate of growth and smallest number of jobs added during this recovery period. Lee and Eddy County still adding almost 1,200 jobs, but considerably fewer jobs than we've seen during the recovery. Farmington actually kind of bucked the trend a little bit there and adding more jobs than we've seen over the last year. And the rest of New Mexico, so New Mexico minus all of those places that I just discussed, moving sideways in the most recent quarter. So again, it's not, we tend to see some revision. We've been seeing revisions to these data. And so next quarter, we may see these things move around a little bit. Although the fact that we've added the smallest number of jobs in the most recent quarter of QCW data of any quarter that we've seen during the recovery, even if we were to see some bump in terms of in terms of the revisions, they are likely to still be much lower than we've seen during any period of the recovery. So that's where we are with that. Moving forward, again, I won't belabor this either. You'll have these slides in the slide deck if you're interested. These are just data straight from the forecast. But this is starting from 2024, so obviously including the growth in 2025 through 2030, which industries are going to add the greatest number of jobs through 2030. So in Albuquerque and in most of the places, it's going to be things like healthcare, professional and technical. Obviously, that's in the very near term before we start losing some jobs in the medium term. Construction, losses to federal government jobs, losses to accommodation and food services. These trends are going to be similar again in places like Las Cruces. adding a lot of jobs in healthcare, losing jobs in places like federal government and accommodation and services. Santa Fe, adding jobs in healthcare, losing jobs in federal government and accommodations and services. Lee County, sort of a weird, different matchup here. More broad-based growth in the various industries, retail, trade, accommodation and food services look like they might be sort of a little bit overextended, and so some fallback over the forecast, and some losses to federal government. Farmington, gains in healthcare, gains in actually some gains in mining in this forecast, losses in federal government. Okay, so I wanted to make sure I left myself a few minutes to talk about this. So a few challenges and risks. And I've been putting these up the last couple of forecasts because I think, obviously I talk about the forecast data itself. I know that the actual underlying data is what's important to a lot of folks. I talk about sort of the expectation in terms of the U.S. forecast and trajectory and the evolution of the U.S. Forecast coming from places like S&P and from elsewhere that I read, just to give you some context for both understanding the New Mexico numbers, but just understanding what the U.S. picture might look like and how that might filter into the work that you do and your expectations moving forward. But not all variables are kind of, and not that doesn't provide a lens into some of the various things that might be affecting the state. So I think last time I talked about sort of transfers, or maybe it was a time before, transfers to New Mexico, and just in a more general level, and how, New Mexico receives a lot of transfers and, relative to other places, and by a bunch of different metrics, we might be at risk. Or talking about things like federal government jobs and how the state might be at risk there because we have a higher proportion of federal government workers in the state. And so if the US government, the federal government actually cuts that workforce, and even if we are impacted by the same percentage, proportionally, that will affect New Mexico more. And by virtue of the fact that we are a relatively rural state, and a lot of the things that those federal workers are doing are providing services to that part of the state, we might be impacted even sort of beyond those direct numbers in terms of how that might filter through to those places in the state. So just thinking about some of those other things and those challenges to the state, I think it's useful to look at things that are happening currently that might not be sort of directly, might be implied by the numbers, but might not be directly reflected in the numbers. So there's a couple things that have been going on over the last few months. Obviously, tariffs are one of them. I think I talked about tariffs the last time. Since our last forecast, we've had Congress do the big, beautiful bill and the president sign it in July. As I mentioned, it's not explicitly included in the S&P numbers, but they said that they think that they have considered, they had included some of the concepts and through lines of that anyway. So there's that. I'm kind of interested, obviously, I'm sure as we all are, in how this will affect the state. And I don't know exactly how it's going to affect the state, but I went and looked at the bill and some of the things that were in it and some of the write-ups that people have made to see what were some of the upsides and downsides. And obviously, I'll show you some other data in a minute so we can sort of draw some conclusions and, at least know what to look at or try to think about. So, some potential upsides, and this is sort of broadly speaking. So various tax cuts have been made permanent. So the original Trump tax cuts that were made in, I think, 2017, those tax cuts, which were generally expected by regardless of whoever was in the administration, those tax cuts, especially with the lower tax brackets, were expected to remain in place. So sort of the status quo, the existing tax brackets. Income tax cuts, corporate tax cuts that were made were also sort of put in place. There's some sort of pass-through tax cuts for small businesses that might make it less expensive for some businesses in terms of their taxing posture. There's some other marginal but positive tax treatment in the bill as well. There have been, as I mentioned, some manufacturing tax cuts, tax deductions, I should say. So for facility construction, for manufacturers to be able to deduct some of those expenses. So obviously, in terms of, and I'm talking about upsides in terms of sort of the economic picture. Deductions for income coming from tips. This one's a bit of a challenge. So obviously, this you would expect would hit some of the lower income brackets. But this one is a challenge because those folks would have to claim the income on their tax forms and then deduct it. This is probably easier to do now, given that a lot of the way that servers and people who receive tax, or excuse me, tips, it's less cash based now and more kind of card based. So maybe that's easier to track. But in any event, it needs to be actually claimed and then deducted. So that's not just a one-for-one sort of benefit, because there's probably a lot of my guess is tip income that's fallen through the cracks in the past, but is may. Expanded state and local tax deductions. So if you live in a state that has high state and local taxes, then you can deduct more of that. You'll have a higher, you presumably will have a higher deduct. And then increase the state tax exemptions. So if you die and you are a multi-billionaire, more than $30 million or something like that, maybe more than 15 million. So I think it was 15 million before, or some number. I don't know. I don't have $30 million. I have $15 million. So not entirely sure what those exemption levels were, but they increased them. So a lot more money in the millions of dollars for each individual that is at those levels will escape taxation. So to those individuals, to those households, to those estates, there are upsides, or at least potential upsides. Potential downsides. This is nothing new to anybody who's been sort of watching the news or some of the analyses. Some vulnerabilities to the social safety net programs. So Medicaid and to I've seen some analysis about Medicare actually potentially seeing some cuts. So Medicaid, in terms of some of the work requirements, some of the bureaucratic requirements and hurdles that are going to be required in order to actually either qualify for Medicaid or to stay on continue to receive Medicaid. SNAP benefits being maybe not as robust or more challenging to get. So some safety net stuff. And also, as I mentioned, a much larger increase in deficits and a much larger national debt stemming from this as well, because the revenue picture in terms of the tax cuts being made permanent and some of these deductions and the like will not, the decrease in revenue will not be offset by the savings that will be had as a result of effectively hiding these dollar amounts from these social safety net programs, which is what I say there on the right. New Mexico being a low income state, relying on social safety net programs and just federal funding generally. The state has, obviously, as I'm sure we're all aware, considerable exposure. And so I have a couple of links down there that talk about the bill and sort of the nuts and bolts from a national perspective. Some of them are more kind of objective than others, but just to kind of wrap your arms around some of the elements there for those who haven't seen it. I want to focus on sort of the social safety net piece, because that's, I think, where the state has its largest vulnerability. Just to give you some broad numbers. So these numbers come from USDA. This is the percent of the population receiving SNAP, just as a measure. So this is what percent of the people in your state are enrolled in or receiving SNAP benefits in fiscal year 2024. What you'll notice is New Mexico is amongst the states or places that has the highest percentage of its population receiving benefits from SNAP. And so any of these states that potentially could see reductions in SNAP benefits will be negatively affected, but by definition, unless there is some other program that comes in to fill that gap. Similarly, this shows the percent of the population enrolled in Medicaid or CHIP. About 42% in New Mexico, according to the data from Medicaid.gov. You can see that the darker the color, the greater the population, percent of the population enrolled in those programs. New Mexico, 42%. Louisiana was about 42%. New York had a high percentage as well. Those are generally the highest, the states with the highest percentages. So to the extent that Medicaid gets cut, or that it gets more challenging for individuals to be on the programs or the like, New Mexico will have more of a challenge than other places, relatively speaking. If we look at it rather than in percentages, we look at it in terms of dollars. This is Medicaid dollars per capita. I should have put the dollar sign there, but dollars per capita. And this is SNAP dollars per capita. The darker you are, the more dollars per capita. So you see places like New Mexico, Louisiana, actually kind of Kentucky and New York being the places that the Medicaid dollars per capita are the highest, so over $4,000 per person, and SNAP per person, so SNAP dollars per capita, over $600 per person. And this isn't per person receiving, I don't believe. I think it's just the dollars. And so in any event, we have exposure. Okay, so I just kind of wanted to point that out. And you know, especially kind of the downside negative stream things, because it seems like a lot of the benefits, with the exception of the tax on tips piece and maybe a couple of the tax deduction things, as child tax credits and the like, could benefit some of the lower income folks in the state. But a lot of benefits of the bill really are at the higher income brackets, at least in terms of the dollar amounts, the raw dollar amounts where these benefits are to be had. And so it seems like on net, that the bill is likely to have more of a negative impact on New Mexicans. Of course, we'd have to kind of try to work through these numbers, be more precise with the numbers than I am here. I just wanted to kind of show some broad things for people to think about. But I kind of wanted to just point that out, since sort of the big thing kind of coming on the horizon here. I think a lot of those cuts are not happening right away. I think that they're supposed to happen after, I want to say after the next set of elections. And so we'll see what ends up happening between now and then, whether some of them are reversed. And if they are reversed, if there isn't a way to actually pay for those cuts, then the deficit will balloon even more, presumably. And so, and the national debt by extension, obviously will expand. So with that said, I will end it here. Our next forecast meeting is scheduled for November the 7th, Friday, November 7th, if I have that correct. If anybody has any questions, I'd be perfectly happy to take them now before I give everybody a little bit of a break. So I have a question. Am I concerned about the increase in estimated components to the CPI? Previously about 10% estimated, now approximately 30% estimated. I don't know that I have, I don't know when the dates are for when they changed how they're measured. I think as long as it's consistent through time, it probably is less important what's measured. I think it's more important that it's consistent and you are kind of apples to apples comparing something. Beyond that, I don't have a lot of thoughts on it. I don't know if you do. But yeah, I think that the more important thing is, do we have like a standard basis for comparison? Increase in estimations tied to Doge cuts. I'm sorry, what specifically are you referring to there? And you're more than welcome to actually speak over the microphone too, if you don't want to type.
All right. Yeah, the increase in like the price specific product prices that they were estimating started around when Doge began cuts to employment and programs, is what I was trying to say.
Okay, yeah. So I think if you go back and actually if you reestimate based upon a standard benchmark, then I'm not as worried about it. I mean, I don't. This is not something that I've looked at closely, and I'm not super familiar. So I have to know more of the details to actually have a more informed response to that.
I'm just going to address it generically, Michael. Most of our statistical programs were hit very hard by some of the changes that were coming out from Doge. And so all of them are trying to adjust because they have to do more with less people. So then the thing is instead of actually sampling, um, you know, sampling that additional 20%, they're going to estimate an additional 20%, if that makes sense. So is that going to impact the margin of error? I think the answer is yes. And I think that that's across all federal programs that have been impacted, including BEA, including some of the Census Bureau programs. So you're having a smaller sample size, so to speak, because that's what costs the government the most money. Is the larger the sample size, of course, less margin of error, but also the more cost it costs the federal government to do it. So I would say that yes, Doge cuts are definitely impacting federal government statistics across the board. What the programs are trying to do, though, is try to address it in the best statistical ways they can to keep it from having too large of an error. But is it going to impact the quality of the data? No doubt. My 2 cents. And you're really concerned about it, and I did this on a personal level, not as a representative of BBER or even a representative of the State Data Center. I reached out to my local congressional district people and let them know that I'm worried about the quality of data from the federal government. That's the best reaction I can tell you, is that on a personal level, if you're really upset about it, reach out to your representatives and let them know that our statistical programs need their funding and need their support, because there's only so much they can do. 2 cents. I'm done.
Thank you.
All right, so I'm actually going to, because I apparently filibustered and I was never shutting up. So I'm actually going to move on at the moment. If you have any questions, obviously feel free to reach out. I'm always available by email. Send me a message. And so I'm going to move on to our speaker, Om Perumal, who, as I mentioned before, thank you so much for being here, Om. I mentioned before, is the Associate Vice President for Research at UNM. And so I'm going to go ahead and just pass it off to him.
Oh, thank you, Michael. Thanks for the opportunity. So I'm just filling in from a colleague here, Dr. Dave Anson, who's the Assistant VP for Research. As Michael said, my name is Om Perumal. I'm the Associate VP for Research, and I oversee the research operations for the UNM main campus. So let me see if I can share my slides. Can you see my slides?
Yes.
Okay, great. Thank you. So, Michael, before I start, how much time do we have? So just want to be respectful of people's time.
Yeah, I mean, 30 minutes or however long you want to go. I mean, longer if you'd like to go, but yeah.
Yeah, I'll try to make it keep it really short. So Michael asked to just talk about the UNM research, what's going on with especially with the federal funding shifts, and also maybe talk a little bit about what we're doing at UNM. So I'll probably talk about a couple of examples, and also can leave some time for questions at the end if you have any questions. Sorry. Okay. So just to kind of give kind of an overview of the research ecosystem, obviously we have the researchers coming with ideas and priority research, questions, and of course part of research is also generating new knowledge. But in order to do that, we obviously need a team of people, and team of people also include partners both within as well as outside the institution. But also an important part of that is having the necessary infrastructure to carry out some of the research. And all of things have to kind of tie together really to have a flourishing ecosystem. So you'll kind of notice as I go through the presentation and some of the things that we are seeing in terms of federal funding shift, how it's impacting some of these aspects of the research ecosystem. So just to give you kind of a high level numbers, this is from the FY24. So total research expenditures was close to 390 million. This includes both the health science campus as well as the main campus as well as the branch campuses. And roughly there are 2,500 publications in 2024. And there were more than close to 1,900 awards at both campuses together. And there's also, again, there's also, we work closely with the Rainforest Innovations in terms of patenting and commercial technologies. So in the last 4 years, obviously that doesn't happen in a year, but depending on when the disclosure happens and how long it takes to patent and as well as a license. So in the last 4 years or so, we have had 33 startup companies formed out of the research that happened at UNM. And more importantly, of course, it's all about the people that we support, both faculty as well as researchers, and we support close to 1,090 students in the last fiscal year. So I just want to give you a kind of trends that we've had in terms of research growth at UNM over the last 10 years or so. As you can see, we were flat for pretty much till 2019, and then 2020 we have been seeing really an upward trajectory. And obviously this year, this is the first year we have seen some of the big shift in the funding landscape. And this is, of course, the dotted line is just a projection. Again, this is all based on, again, things are changing sometimes weekly, sometimes on a monthly basis. So as of July, if based on the loss that we've seen, we anticipate at least 10 million loss for the FY25. And of course, FY26 to still be determined because obviously we have the new budget and things that's been going through the Congress and how it impacts in terms of research growth. So I just wanted to show this graph that we were really on an upward trajectory. Obviously, with the changes, you may see some impact, and not right away, but also definitely going forward. Definitely for sure in the next year, we'll start seeing some shifts and it determine, obviously, we don't know a lot of things that's happening in terms of the budget and how the different agencies are responding to the executive orders as well as the budget cuts. And just to give you a snapshot of where most of funding comes from, as you can see, the red pie chart in the red portion shows around 62% of our funding comes from federal. And then we do have quite a bit of use institutional funds to support a lot of the research. You can see that that's the next biggest piece here. And then we have roughly 5% and 5% from the state and local government as well as from the private foundations. And although it says, this says 63%, but this is a direct funding from federal agencies. We have a lot of the federal pass-through money, which comes to the institution as well as to the state contract. So if you take that into account, actually it goes to close to 80 to 84% of our total funding is federal, direct or indirectly. And how does UNM compare with the rest of the other universities? National average is around 55%. So UNM is slightly higher than the national average in terms of how much of the funding comes from the federal sponsors. Now, I want to kind of highlight a couple of things, the positive things, and start with the positive things happening at UNM. And this has been something where the state has been extremely helpful, and state support has been extremely helpful to move some of this initiative, very important initiative, not only just for the New Mexico, but also national as well as global. So one of them is the Quantum New Mexico Institute that was started and established in UNM in January 2024. And within a year, we have had a lot of traction. This, of course, because of the interest in quantum. And in fact, if you look at the Quantum Business Magazine, actually, Albuquerque was listed as one of the 7 cities in the United States as a hotbed for quantum because of the national labs and because of the research that happens at UNM. Although, quantum, there's a lot of buzz about quantum lately, but at UNM, that's been, in New Mexico, I should say, quantum has been a focus of research since 1980s, including the national labs as well as at the physics department at the UNM. So, and part of the thing, if you look at the magazine, they listed the reasons why the cities were chosen as the hotbed cities, and some of them are Pittsburgh, Minneapolis, Austin, and Rochester, New York, and we're right there along with those cities. And they point out some of the reasons. One is, of course, the world-class research institution, entrepreneurial ecosystem, and pro-innovation government support. And I'll talk about that in a minute, about the state support. And of course, quantum solution that is not only benefits the region, but also to the nation as well as across the globe. And one of the big things that came out of this Quantum Numerics Institute is the uh, a big program from the EDA, which was the Elevate Quantum in a collaboration with Colorado, which is close to 126 million for 5 years, which also included state support. We had, I think, close to 70 million from Colorado, and from the governor's office, at New Mexico is close to $10 million, and there's additional support that is coming from the state. If you had not had the state support, I don't think you would have been competitive at this for this Elevate Quantum. We were one of the 12 that was selected for this Quantum Elevate Quantum Hub, which is primarily to promote the science and technology, but also the workforce development regionally, and also to bring in new startup companies to the state and the region. So this gives you a snapshot of some of the things that's going on in the Quantum Numerics Institute. Actually, we just hired a new director for the Quantum Numerics Institute, and he's coming from Federal Lab, and he'll be starting in later this month, actually. So we're pretty excited about the new directors coming in and coming with some national experience will help us to build some partnerships as well as also funding. So we also had a bit of state support, and this legislative session we had close to $2 million for the QNM Institute, mainly on the workforce development and to support fellowships. And then we have another 20 million potentially that we could be go to the New Mexico support the New Mexico quantum ecosystem. And we also lately been working with the UNM Downtown Quantum District and the city of Albuquerque to really what we like to call is the Downtown Quantum District, including which of course involves the collaboration with the Sandia National Lab as well as LANL and others and the regional partners. So if you look at the focus of the Quantum Numerics Institute, there are mainly three focus areas, mainly the computation, communication, sensing, photonic materials, laser systems, and imaging, which has always been a strength at UNM, but also with the partners at the Sandia and LANL, really the synergistic collaboration to really work on this areas of research, which is really an area that's been evolving. And obviously with the quantum and to put in a simplistic say, things that happen at atomic level that it could increase the speed of computation, which has significant impact on multiple industries, from quantum computers to pharmaceutical industry in terms of drug development to sensing and remote sensing, as well as in defense and other areas. And we also, in addition to the research, there's also a lot of focus on the workforce development, and as well as the outreach, both at the K12 level as well as at the higher education level. So there has been also recently we hired a couple of cluster hires at UNM, and then we also have two more offers that's out there to hire additional faculty to strengthen this area of research. And just a minute, I want to talk about the EDA Tech Hub, which is part of the Elevate Quantum in collaboration with the Colorado. And this again is $127.5 million for 5 years, which includes 40 million from EDA and 10 million as a contribution from the New Mexico State, as well as close to 77 million from the Colorado. And the main focus is, of course, as I said, workforce development and also bringing in new startup companies. And one of the companies that is most likely to relocate to New Mexico is Quantanium, which is one of the leading startup companies in the area that we're excited that'll be gives an opportunities to work with them both in the workforce development, also on the technology side of things. And just to give you again an idea of where this the 12 quantum hubs are, as you can see, there are 12 quantum hubs, and then we are one of them. And as you can see, there are a lot of states have been supporting some of those initiatives. And again, we are really thankful and grateful for New Mexico for the support from the state, which enabled us to bring this Elevate Quantum, be part of the Elevate Quantum as part of this national initiative. And again, this, as I said, there are three main areas: computing, sensing, and communication, and which impacts multiple industries, from pharmaceutical industry, biotechnology industry, oil and gas industry in terms of sensing, as well as remote sensing in defense, as well as space research. So it impacts multiple areas of research. And again, as I said, it's an evolving area that would significantly impact, improve our ability to quantify, in terms of computation, but also in terms of advancing some of the technologies in all the three areas. The other center we want to talk about is the ERIT Center, which is also relatively new, which was launched in 2023. The ERIT Center, which is Accelerating Resilience Innovation Drylands Institute, which also has a direct impact on the state, mainly in terms of the water, in terms of clean water, energy. And this was again started in 2023. The center has all been up and running and close to receive close to $20 million in new funding, both from federal and state. And again, we're also excited with that. We just hired the new director. I think she's going to be starting in September of this year. So again, she's also coming from a national lab. And as you probably heard, there are a lot of layoffs in the national labs, which is in some ways good for us because we're able to hire some of the national labs with the experience of the national labs who could bring that experience here, not only build the ecosystem here, but also build those partnerships with the national labs and other agencies within the region as well as across the country. And just to give you a snapshot of some of the projects that they're working on, enhancing ecosystems, hydrology modeling, impact of wildfire and forest management practices, and potable water usage. And then the Civeta long-term ecological research program has been continuously funded for the last 10 years or so from NSF. And this is something also has been impacted with some of the grant termination as well as with budget cuts to NSF. And we were recently we were submitted to what is called as the NSF Regional Innovation Engine. This is a new program which started in NSF 2022. The idea here is to really build partnerships and build a local ecosystem in terms of research, innovation, workforce development. And we were one of the 29 awardees who are selected for the first phase of the award, which is 2 million for developing this partnerships. As you can see, there are several partners, both higher ed institutions as well as the community college, as well as a lot of startup companies and industry and community partners. And the first phase of funding was really to build these partnerships. And in fact, we got a 1:1 match from the state. Again, the state support has been significant critical in getting this thing started. And actually, which recently, a couple of weeks ago, we were notified that we were one of the 29 across the country to be selected as semifinalists for a next phase of funding, which is close to 10 years of funding, up to $160 million, which is a huge amount of funding. So we had a virtual site visit last week, and we probably have one more. It looks like if it moves forward, we'll have a in-person visit sometime this fall, and then we'll know whether it'll be funded or not in spring of 2026. So we are really excited about this. Again, there's not only in terms of the funding, but also the partnership that could be built through this innovation engine. And again, this focuses, and came out of the ARID, the center that I talked about earlier. And this is a nexus of energy as well as water. And again, there's also a big focus on innovation, entrepreneurship, and workforce development. So, we're really quite excited about the fact that we have been selected among the 29 across the country to be part of this as a semifinalist. Of course, again, we need to a couple of more steps. We know we'll be funded this 10-year funding from NSF. So as you can see in this map, in pretty much in the middle as well as the west, there's not many, and we are one of the few selected across the country to be a semifinalist. So I'll be able to report on the results in hopefully the next quarter if we get to know about they're selected as a finalist for funding. So I want to switch gears. Michael asked me to talk a little bit about the funding impact that is had on UNM. So I want to give you some numbers. Again, some of the numbers, don't hold me to the numbers. But again, as I said, things are changing because things are changing by the week and sometimes changing by the day. And summer has been lately quiet compared to the first 3 or 4 months. So again, so the numbers, what I present may not be true, maybe in a week or maybe in a month's time. So I want to give you a higher level overview, but then I'll be happy to answer any questions you might have. So just to give you a snapshot again, there has been more than 150 and probably more executive orders in the last 6 months or so. At least 1/3 of them directly impact federally funded research and development. So in terms of legal responses, there's been more than 230 legal challenges. And again, all of the legal challenges are not related to research, but many of them could be directly and indirectly impact research. And New Mexico was part of the coalition of 22 states, and some of the successful lawsuits, especially one regarding the F&A cap, the facilities administrative cap, the 15% cap. So currently, most institutions would negotiate a rate, and our current rate at New Mexico is UNM is at 52.5% for federal contracts and grants. So the NIH is the first one which actually came up with a cap in sometime in February, saying that they'll not be funding at the 52.2%, not the negotiated rate at across all institutions across the country would be at cap of 15%, which is huge, has a huge impact on how we conduct research. And that led to multiple lawsuits, and New Mexico is one of the lawsuits. And actually, right now, I believe it's a criminal injunction. So the NIH is not implementing that 15% cap. And then once, I mean, after NIH, then we also had NSF come up with a similar cap, and that is also currently, I think there is a preliminary injunction on that. And then DOE, Department of Energy, came up with a similar thing. They're also currently, and there is a injunction on that as well, and as well as the DOD. So far, most of the F&A cap lawsuits have been successful, but that doesn't mean that the agency cannot change anything going forward with a new budget and things like that. And there is also one pending lawsuit, NSF lawsuit that we are part of. I mean, when I say we're part of, the New Mexico State is part of, is the NSF grant terminations. We were also part of the NIH grant terminations, a lawsuit which actually the court dismissed the NIH argument, and there are 900 grants. Most of them were blue states, obviously 22 plus states was part of the lawsuit. So most of the grants that are terminated from NIH have been reinstated as of last week. I think pretty much all of the grants that were part of the list in the lawsuit have been reinstated, both in the mains campus and the health science campus. And a lot of them had to do with training grants for graduate student postdocs, as well as development grants for the faculty. And there is several lawsuits that still there are, the federal government is appealing some of the decisions. So we'll have to wait and see what happens with those. But it is also another pending NSF lawsuit that New Mexico is part of, which is again it's in regards to the NSF grant terminations. We have not had a decision on that as of this week. So we'll have to wait and see how that all plays out in the court. So in terms of UNM's response, and so the president, UNM's president, actually way back in when this started in January, early February, set up a different what we call as a rapid response team to really to monitor the changes and communicate those changes to the campus community, but also to come up with strategies to address some of the issues that might come up because of funding cuts and other things. So one of the rapid response team is to do with the research, which includes the VPR office, as well as folks at the government relations, as well as the legal counsel, both the main campus as well as the health science campus. So we've been meeting almost sometimes twice a week, and initially thrice a week. Now twice a week. Now in the summer we've been meeting once a week, really to go through some of the. And there's been a lot of, as you can imagine, a lot of things going on with regard to the federal agencies, because each federal sponsor responded differently in terms of the language they use in the agreements, as well as in terms of the F&A cuts, as well as in the budget cuts, and so on and so forth. So we've been actually monitoring those closely, and then kind of curating that and kind of vetting it, because sometimes we have to make sure the information is correct, because people are getting information from a lot of different sources. So we've been sending those communication internally to the faculty as well as staff, and so they are they're up to date to what's happening. And in addition, the university has also come up with, at least for the last spring, to help alleviate some of the funding cuts, terminated grants, especially for grad students who are closer to graduation, to come up with the bridge funding, working with the provost of at UNM. And then we also been working with the faculty to see if we can, the grants are terminated, which you can actually resubmit or revise those and submit to the other private foundations, so on and so forth. So we've been trying to be nimble and try to provide as much as support we can. Again, I know there's a lot of uncertainty, but we have been trying to communicate and communicate timely, and also making sure we are able to respond as much as we could in terms of respond to some of the changes that's coming down from the federal sponsors. There's also, again, not only the existing awards that have been terminated, but also there've been significant delay in issuing new awards. So that may mean that we will not be able, we are not able to hire grad students as well as start the projects till we have the funding in place. And again, different agencies work differently in terms of how they release the funds. For example, NIH releases the funds annually, whereas NSF gives all the money upfront if it's a multi-year grant. So we have been trying to sort out some of those things and trying to be as responsive as possible to address some of the issues that may come up from faculty or from students. Of course, we work very closely with the government relations team, and then the state as well, state representative, as well as with the congressional delegation. Our government relations team has been doing a phenomenal job of keeping them updated on what's happening, and also been working closely with in some cases to help with the reinstatement of some of the grants and so forth. So it's really a team effort. So as of this Monday, this is the status of terminated or reinstated grants, and this is only talking about grants already ongoing. It's a multi-year grants. They've been terminated because of the executive order for one or the other reasons from various agencies, and most of them happen to be NIH and NSF. There are some of them are National Endowment for Arts as well as the National Endowment for Humanities, and some also from Department of Transportation as well. So as you can see, we had before the reinstatement of the NIH grant, we had a total of 62 terminations and some more stop work orders. So close to that, that would mean we pretty much were going to lose like close to $36 million of federal funding. So I would say more than half of them have been reinstated. Again, majority of them happen to be NIH grants. As I said, we were part of the lawsuit that is successful. That resulted in reinstatement of close to, as I said, half of the terminated grants, total grants. So we currently, as of again, as I said, as of earlier this week, and hopefully we don't have any more terminations. We currently were, there are $10 million, close to $10 million loss of most of them coming from NSF. The NSF grants not been reinstated as of this week. So, and although most of the things we have appealed, we have and some of them we have not got any response from the federal agencies at all. So it remains to be seen. Again, as I said, there is a pending lawsuit for the NSF termination. So again, that decision is pending. So we'll have to wait and see how that all plays out. So as of this week, as I said, there's close to $10 million of loss of already obligated funds from the federal agencies. And this, again, majority of them happens to be NSF, National Science Foundation. So there'll be other big focus if you've been listening to the news about a lot of focus on the F&A cost or overhead cost and the cap. So I want to give again an overview of what it means for the institutions, what are direct costs and F&A indirect costs that people like to call overhead costs. So as the direct costs are the ones directly funds the research, for example, like the material supplies directly related to the project personnel, the activities related to the project, for example, publication costs, travel to conference, and so on and so forth. But the indirect or the overhead cost is what we like to call the cost of doing business, right? So it's a research infrastructure, the lab space, the core facilities, the library facilities, the grants administration, because there are significant compliance requirements, which has a significant increase over the last 15 or 20 years, although the F&A rates have not increased. So there is, just to be clear, there's two aspects of the facility administrative cost. So there's F, which is the facilities cost, A is the administrative cost. So this is negotiated every 4 years in all institutions and based on where they're located, based on their cost of doing the business. So every institution has a negotiated rate agreement with the federal government, and pretty much all of the federal agencies, pretty much follow the rate that is negotiated. So every 4 years they'll come and do an audit, and then we have to submit all of the paperwork to do and get all the facilities recertified, if you will, to get this facilities administrative cost. So currently at UNM, our negotiated rate agreement is at a 52.5%. So on the F part is the facilities and infrastructure, the A part is the administrative cost. And the administrative cost is capped for all institutions, capped at 26%. So no matter what your total cost, F&A cost is, but the administrative cost is capped at 26%. You cannot charge more than 26%. But that being said, for the last 20 years, the administrative cost has significantly increased, mainly because of compliance requirements. So just to give an example, the last 3-4 years, we have had more compliance requirement in terms of research security, especially for the foreign influence on research. So that is a huge increase, but although the administrative cost, the cap has not been lifted. So pretty much a lot of the cost still the F&A, whatever we charge, still doesn't cover the full cost of doing business. So some of them are covered by institutional funds. So just to give you an idea of what the current rates and how much it covers the cost of doing the business. So a good example to think about this is like as an oil change, as an example. So when you go to for an oil change, you actually pay for the oil change. Obviously, of course, the business running the oil change business, so they have to take care of the other thing which you don't see directly when you're doing the oil change. For example, the electricity cost, the property insurance, the safety hazard removal cost, and all the accounts and billing and all of those costs. So this is, of course, not directly charged to a specific project, but is kind of doing the overall business. So it is how you want to think about the research enterprise. It's a reimbursed cost. So when an institution submits the grants, we are really reimbursed the costs. Some or most of the costs that all be invested on the researcher as well as research facilities to do the research and to help the researcher do the research. So in terms of what are some of the costs, just to give an example, especially even examples like research labs, we have specialized labs and equipment that need to be maintained, as well as Sometimes we would expand those facilities, doing some sort of special type of research, as well as core research equipment facilities, as well as libraries and journals and publications, environmental health and safety. And then we also have research faculty startup costs and cybersecurity, which is, that's an increasing cost, which is, increasingly become important in general, but also more specifically in research. Because a lot of research development, administrative costs, for example, research development and managing the awards, physical compliance, as well as research computing and purchasing and the research contract legal services that go along with that. So in general, if you look at this is the numbers from the COGR, which is the Council of Government Relations. So roughly, 73% of every dollar federal research dollars, 27 cents supports the F&A cost. Now there is a percentage, there is a negotiated rate. So every dollar, so 73%, a majority of the cost is the direct cost, and there is 27 cents is what covers F&A cost. And this is a national data, but this doesn't cover the entire cost of doing business. So a lot of them are subsidized by using institutional funds. There is still a unrecorded F&A of 5.2 billion, which is not covered from the federal sponsors, but that is usually covered by the institutional by the institution using various sources of funding. Now, it's also important to remember that a lot of the costs are excluded from direct cost calculation. For example, if you have a sub-award giving to another institution, the limit was recently increased to 50,000. So you can only charge F&A for the first 50,000. If the grant is for $200,000, the sub-award is for $200,000, you only charge F&A for 50,000. The remaining $150,000, you cannot charge F&A on that. The tuition remission for grad students, it's also excluded. There are also participant costs and patient care costs and health sciences side of things, which can't be charged to which you cannot charge F&A. So that means there's also what we call the modified direct cost, which means it's not directly all the items in a budget cannot be charged as F&A. So a lot of them have to be taken by the institutional funds. So this is our currently negotiated on-campus and off-campus rates. So only DOD we have 54%, but this is 15.5% at UNM. So if you look at some of the other institutions, comparable peer institutions, so we are right about the middle and average in terms of the F&A. We need to be, some of them are of course higher, like Arizona State University at 67.7. We are rightly about kind of the national average where our negotiated rate costs are F&A. Now that being said, not all grants provide F&A. For example, if a training grants, you cannot charge F&A on that. So if you look at really the effective F&A, which means they would take all the federal sponsors, all the grants that we get, and they divide it by the total F&A we generate, that only comes down to close to 23%, which is not almost half of the actual negotiated rate agreement. The reason it's lower is because not all grants you can charge F&A. So that means some of the training grants, you cannot charge F&A. So that reduces the net effective F&A that we generate in total is actually close to 20%, half of the actual negotiated rate. So even with the current rate, we don't really recover the full F&A of doing the research for the research enterprise in total. So what is the if at all 15% cap goes into effect? As I said, right now they're all on pause because of the court orders. That would mean currently, if you look at both the campus together, we generate roughly close to $68 million of F&A. If the 15% F&A cap goes in effect, the UNM specifically will lose $30 million per year, which will mean in the long term we have to wait and see if this is going to affect. That being said, there's also a national project going on with a different association trying to come up with a new model for F&A. And we'll have to wait and see if the Congress adopts the model, and that that is not 15%, not the negotiated rate, somewhere in between. So people have been working on different models, and I mean in contact with OMB as well as the Congress to see, and all of them understand the impact this would have on research enterprise across the United States. So if this 15% F&A cap goes into effect, and it will definitely significantly impact UNM research and the ability to do research, and our ability to continue to be a leading research university. So that's the impact. But again, as I said, right now there is a pause on this because of the court order. So again, it remains to be seen what the new F&A is going to be, what the rate is going to be, and then we'll have to again assess the impact at that point of time. So currently we don't know at this point, but we know there's we are allowed to use the negotiated rate agreement for now. But again, depending on what happens, the budget and everything else, we'll have to wait and see what the new F&A rate will look like. So again, this also supports different aspects, the research infrastructure, the faculty research support services, different offices, in fact, including the VPR's offices support the F&A. So the reduction of funding will have a significant impact on all of these aspects of research into the people, as well as the infrastructure, as well as the support services. In terms of the economic impact, just I gave an example here from NIH. So each dollar the federal government spends, for example, NIH, it results in $2.5 of an economic impact. This is specific data related to New Mexico. Of course, this doesn't include, this not only includes UNM, but all the institutions receive NIH awards. And this is the list of top NIH funded institutions at New Mexico. As you can see in the last year, FY24, there were 125 million NIH awards, which result in $290 million of economic activity, support close to 1,500 jobs across the state. And this all related to top, some of the disease, top 5 cause of death in New Mexico, for example, heart diseases, cancer, COVID, chronic lower respiratory disease, and stroke. And these are some of the research that's been supported to NIH. So and again, as you've been hearing in the news about the budget cuts, is at least proposed close to 40% cut in NIH budget, as well as NSF close to 50% cut. So it can have significant impact on the ability of the institution to research if that goes through. So again, it's to be determined. I suppose we don't know the final what the budget numbers are, so we are still waiting to see what the numbers are, and then to assess the impact of those budget cuts. So to summarize again, as I said, although some of the NIH grants were reinstated, this is only for this year. So because as I said, NIH releases the money year by year, so we don't know what will happen next year. It'll depend on the budget, although it is already. So they're supposed to multi-year awards. So like for example, some of the grants we are in the middle of the multi-year, like a 5-year grant, we are in the 3rd year. So the reinstated grants supports for this year, but we have to wait and see if the other 2 years will be supported or not, because again, NIH releases the money annually. So as I said, the new awards have been significantly delayed. We are seeing some come through NSF, but not so much NIH. They're slowly coming through. There 1 or 2 have come through in the last couple of weeks. So that's delayed significantly the start of the project, also and the ability to hire grad students and postdocs and others. And again, as I said, the FY26 budget cuts is still it's been finalized. So once we know what the cuts are, that will also have an impact on our research enterprise, because it impacts the people mainly. I would say faculty, grad students, postdocs, and of course the long-term impact on some of the projects, both in clinical studies as well as other types of research. So we also, at the same token, we are trying to align in terms of research priorities for the new administration, like AI, quantum, and geothermal. And I showed you a couple of examples, like the Quantum New Mexico Institute. That's an opportunity for us. So we're trying to strengthen those partnerships and build partnerships both with the industry, national lab, state, and community partnership. And so it's critically important to continue those partnership and funding in order to remain relevant with the new funding opportunities. So I'll stop here and see if you have any questions. Again, thank you.
Yeah, thank you so much, Om. I really appreciate the presentation. I know everybody else here did as well. I think it's useful. I mean, we're biased being seeing these we work at UNM, but I think that it's important that people realize how UNM is an economic driver to the state, and in terms of the research that we do. And the federal funding and the cuts to federal funding and the uncertainty regarding funding makes it challenging for people to actually do research, makes it challenging for UNM to be competitive. And actually, and I know this is a national problem as well, but makes the US less competitive potentially. I don't know how many advertisements I've seen from other countries throughout the world, everywhere from continents, everywhere from Europe to China and everywhere in between, trying to recruit scientists to do work in an environment where those scientists are likely to feel that they're going to have a more secure line of funding to do their research. And the idea that their funding could be cut at any moment disincentivizes science. And so, yeah, that's a lot of the reason why I wanted somebody from your office to talk. So I think it's important for people to know that broadly, and for the state to understand how critical this is to the vitality of the state as well. So thank you so much. Are there any questions for Om? Great. Well, if you do at any time, go ahead and forward them to me, and I'll make sure that I'll get them as well. Thank you all so much for being here. I definitely appreciate it. Again, thank you for coming to talk to us. Again, feel free to reach out to me at my email address. You all have it, but it's mo8684@unm.edu. And I'll see you guys again in November. So have a good rest of your summer. Thanks so much.
Thank you.